The death of long short equity is much exaggerated. This idea in the marketplace that there's no skill among bottom up stock pickers is for sure wrong. What I see is some of our partner funds generating extraordinary returns in their own strategy and really struggling to raise money. There's a lot of alpha there, but how do you then size those positions and how do you manage the overall portfolio construction? That's a whole different story. The next leg of that story is this single manager alpha capture and single manager active extension.
Today's episode is brought to you by Fiscal.ai, the fastest growing equity research platform on the internet. Later on, you'll hear more about Fiscal.ai and in particular, what it can do for professional investors. But for now, let's get into it. Before we get started, I want to do a quick disclaimer that nothing we say here is investment advice, as well nothing we say is marketing or advertising for CenterBook partners or any of their funds or strategies. Everything is meant to be informative about the fund management industry. Welcome to Other People's Money. I am joined today by David Stemerman, CEO, CIO, and co-founder of CenterBook Partners, a multi-billion-dollar equity multi-strategy long-short hedge fund that, as its name suggests, is focused on using alpha capture strategies to build its portfolios. David, thank you so much for joining me today.
Max, thanks for having me.
All right, so I know we're going to be talking about alpha capture, the multi-manager world, but I wanted to start out just with a question about your background because you don't come from that multi-manager pod shop world. You were a partner at the notable Tiger Club Lone Pine, and you ran your own long short fund. So your DNA is really in this sort of single manager long short world. Can you talk to me about that background and how that informed the strategy that you're trying to build with CenterBook?
Absolutely. I had never even heard of the term alpha capture before building this business because my background was as a bottom up stock picker. I had a great opportunity to work with Steve Mandel at Lone Pine, who was one of the great stock pickers of all time. And that's really my background. When I was at Lone Pine at our investor day, I pitched Apple as a long at a time when one of my partners said, "Well, they're opening stores. This sounds like Gateway and must be a great short." So it's carried on into Canadas Capital, which is the Tiger Grand Cup that I ran. We invested across all sectors of the economy all over the world, picking one stock at a time.
A lot has changed since those early days with Lone Pine. I'm sure if anybody has paid attention, there's been a lot of lamenting about the death of the long short model. And I know that that's something that you're seeing too. It's not quite dead, but it's certainly been under pressure. What is happening with long short managers and why do you think that alpha capture is a potential solution?
So when I launched Canadas in 2008, and at that time we were the largest single manager long short launch with over $2 billion. Being a great stock picker was enough, and that's all you really needed to focus on was, if I can get my stocks right, do I have good research so I can size up my best ideas, and that was really successful. And the Tiger Cubs, and that was the world I came from, really burnished their reputation in 000102 when the markets were down year after year. And those hedge funds not only preserved capital, but made money in tough times and made money in good times as well. 2008 was really a very different story with a broad market decline. And 2022, more recently, was another case where it was a tough year in the market and a lot of directional long short managers not only were down in line with the market, in some cases were down even more. And so that's really created some challenges for the strategy. Allocators have increasingly thought about their portfolios for the hedge fund component as being uncorrelated and not having any beta or net exposure. And increasingly, they've migrated to multi-managers and other market neutral, factor neutral strategies. And the bottom up stock picker that typically runs a directional strategy is increasingly in a world where there's less and less capital available, fewer and fewer allocators interested in that type of strategy, even if they're generating great returns.
Yeah, and that is the key point. Despite this lack of interest, your research and data has shown that there is alpha to be had even if it is sometimes masked by market forces, factor forces. So, what are people missing? Where is this breakdown?
Yeah, well, the return stream of a directional long short manager is a mix of alpha from stock picking, beta from market exposure, and then factors. So bottom up stock pickers generate a lot of alpha. It just can be hard sometimes for allocators to see. A directional long short manager, the returns are a combination of the alpha from their bottom up stock picking, but that also can be their beta, which can be variable, and their factor exposure. So, Canadas Capital, the fund that I ran, was a growth manager. And so, if growth was good one year, it would be a tailwind. Was bad another year, it would be a headwind. And it's tough for allocators that just see the overall return to really understand where there's manager skill. And so one of the benefits we have at CenterBook is that we're able to look at managers' returns on a daily basis and run it through a risk model. And what we find is that managers with a long-term investment time horizon that are process disciplined, that use price targets, scenarios, they're really, really good at what they do. And if you could invest purely in that bottom up stock picking skill, which risk model would identify as idiosyncratic returns, it's a wonderful return stream. And so the irony of where we are today and the opportunity for CenterBook is that return stream is increasingly being ignored by allocators that have been uh, moving away from these directional long short managers. But it is it's there, and CenterBook's role is to be a partner to those funds to help unlock that alpha return stream and to then deliver it to these allocators in ways that meet their portfolio objectives. That increasingly they don't have this alpha in their portfolios, and it's something they need to complement increasingly their multi-manager exposure and others.
So alpha capture is not a new idea. It does have a long history. It's taken many forms, whether that be in the form of taking alpha from the sell side, internally at multi-managers from the pods themselves, and then also with the rise of SMAs and the transparency that allocators are getting, into portfolios in real time, they themselves are running alpha captures if they have an internal team. So where does Centerbook's alpha capture differ from these historical and existing forms of alpha capture today?
Yeah. So the two models you highlight are worth exploring a little bit. So the original alpha capture came from Marshall Wace, where the founding partners Marshall and Wace had a bet as to whether sell side buy sell hold recommendations had any value. And the partner who said yes won. They collected data from sell side firms and have built a business that now manages tens of billions of dollars. And so that idea that you can collect data from multiple contributors, uh, evaluate it using best practices for systematic portfolio construction, and then deliver great returns has over 2 decades of evidence. In terms of applying it to the buy side, it's predominantly been done internally for funds. So if you're at a multi-manager, one of the ways that the multi-manager makes money is that they take your ideas and they trade on top of them, and in a center book type strategy. What's different about our business of CenterBook Partners is that we're partnering with independent managers, and we're building a systematic CenterBook portfolio from these independent managers. And in order to do that, there's a lot you need to do to make sure that you're protecting those managers and their investors from any negative market impact. And then there's got to be an incentive of something in it for them of why they would join you to participate.
Probably most people, when they hear alpha capture, are thinking of the multi-manager model. And naturally, if you felt it was necessary to write this position paper as to why you think you're doing alpha capture in a responsible way. There's a belief out there that alpha capture is being done in an irresponsible way. So, the alpha capture that most people think of, what are the common criticisms that people have that say that this alpha capture is not a good thing?
So we did put out a white paper just recently, and in some ways it echoes a white paper put out by another hedge fund manager, SquarePoint, earlier in the year about SMA platforms. And the idea behind it is we share this quote in the white papers: just because you're paranoid doesn't mean they're not out to get you. And so uh, the the model for some in trading the contributors' data is to trade right on top of them and to use a replication strategy. And if that's what you do, then you're driving the price away from the best execution, and it's effectively worsening the execution price for your trades, and it's harming the underlying returns to fund. And so the paper that SquarePoint put out was very much talking about what is what are the right standards, what's fair use, how do you protect IP in the case of an SMA, so that if you as an allocator have funds with a manager or a manager themselves, you can not be worried that the fund manager is going to be trading in a disadvantageous fashion. This is the parallel for alpha capture. And what's interesting about the managers that we partner with, who are bottom up fundamental stock pickers, is that they have a long duration for their alpha. And this is a critical distinction relative to the sell side alpha capture of Marshall Wace, where the alpha only lasts a few days. And for the alpha capture in the multi managers, it's typically a shorter term investment time horizon, at most a quarter, often a month. And again, if you don't trade it quickly, you're going to lose a lot of the alpha. One of the interesting insights we had from our research is that you could wait several days before trading at all and capture almost all of the alpha. In addition, what we find is that while our managers that contribute to us are great stock pickers, they're not necessarily awesome at timing. And so what we find is that we have some very different ideas about how and when to trade. And so most of the time that they're trading, we're not trading at all. And we're very often, we can be trading at a time in the opposite direction as frequently as in the same direction. But the idea for the industry as a whole is let's provide guidelines, let's provide accountability, transparency, and accountability. And so in the paper, we outline an approach of how you could measure market impact based on the volume of trading of the manager, the volume of trading of the alpha capture platform, and you can calculate what that impact is. And what we have seen is that an alpha capture strategy with long-term managers can have barely any impact. You can then provide transparency to the manager. And then really the best practice is to say, if there's any negative impact on the fund, the alpha capture manager should reimburse the fund. That's the way that you really can take this issue off the table, so the manager and their allocators can rest assured that the trading is not undermining their returns.
Are you even always trading in the same direction as your managers? Do you find managers that give you signals where you actually want to do the opposite of what they're doing?
So our approach is not to be trading against our managers. What we find is that we can trade position sizing at different times and in different ways. And so many of our managers, in addition to providing us with their portfolio data, they provide us with their price target research and a model portfolio that they have developed using a software tool called Alpha Theory, which is a tool that I used at Canadas to help me with position sizing. And the idea behind it is that you can load in your financial model. You can have multiple scenarios for price targets. You can put in qualitative insights like the quality of the management team. You can put in portfolio decision rules like a max position size, max loss tolerance, and that can provide a systematic model portfolio. We find there's a lot of information in a portfolio like that because the manager is now giving you information. What would be the return potential one stock at a time? But when the manager constructs a portfolio, they have to think about how do all the stocks fit together and how do you manage the risk of the portfolio as a whole. So that leads us to have insights to trade the portfolio at different times and different ways than the manager might themselves. In addition, the market is always moving. And I knew running Canadas that I was only so good in my trading efficiency. Well, at CenterBook, that's one of our core competencies, is trying to figure out when is the return potential better than the cost of execution and factoring that into how we trade. And so that's part of the value add. When we think about alpha capture, we think about it as highly additive. We're able to help the underlying fund manager unlock and deliver more alpha than they're able to produce in their own strategies, and then make that available to allocators in a way that the manager really wouldn't be able to do on their own.
For many investors, financial data from Bloomberg, Refinitiv, Capital IQ, or FactSet is one of their biggest research expenses, with individual seats costing upwards of $20,000 per year. Despite these high prices, these platforms have been dominant in the financial data industry. That's because many of the cheaper alternatives don't actually own their data. Instead, they're licensing from these big data providers with terms that forbid them from allowing you the ability to download it. For professional investors, downloading and working with data in Excel is a must-have, and it's a major reason the proverbial Bloomberg killer has been so elusive. All of that is changing with Fiscal.ai's new enterprise tier. At less than $2,500 per year, Fiscal.ai provides much of the same stock market data at 1/10 the cost of Bloomberg. And you can download it all because they actually own the data. Instead of using huge workforces outside of the US to manually input data, Fiscal is using new AI technology to gather data directly from corporate filings, making it cheaper and faster than the labor-intensive incumbents. That's also why Fiscal's data is updated within minutes of corporate earnings releases. And before you ask, yes, they do have adjusted forward estimates too. Don't just take my word for it. Start a free trial today and use the link in the description to get 15% off any Fiscal paid plan, including their enterprise tier for professional investors. Let's get back to today's interview. So what I think is interesting is that in this scenario, there are almost two groups of non-economic actors. There's a group of allocators who are not willing to look through the volatility to get the alpha that comes over the long term. And then you have the managers who are not willing to meet the allocators where they are in the type of return stream that you want. So why don't the managers just adapt their strategies to be something that is more palatable to these people who control the keys to all the capital?
Yeah. If only it were that simple. Just to highlight a little bit of where the problems are, and maybe uh, uh, giving the allocators some credit for why they're structuring the portfolios the way they are, and then maybe stepping in the shoes of the bottom up stock pickers of what they're dealing with. And that's, I think, part of just taking a step back for CenterBook. Our name is CenterBook Partners, and our aspiration is to be great partners to both in helping them meet their objectives. And so for the allocators, the experience that they had coming out of 2008, as Bill Clinton would say, I could feel your pain. Uh, I was asked to run the investment committee for my girls' school, Greenwich Academy, and I was asked to do that starting in September of '08, and we had a portfolio of prize of a lot of hedge funds that had done really well, and it preserved capital and made money, and not so much in that period of time. And what had led a lot of allocators, endowments, foundations, pensions that have both long-term investment time horizons, but also they have nearer term needs. that they need to think about their portfolio in different buckets. And so Professor Clay Christensen talks about what's the job something is doing for you. And the job that a hedge fund should be doing for you in this construct is I need some part of my portfolio that can deliver returns for me in good times and bad, and that is going to be uncorrelated from the markets overall, for the equities. And that's increasingly what they're looking for in their hedge fund exposure. And so the challenge for the traditional directional long short equity is that it has some beta, and so it's correlated. The other area that allocators are looking for help in is in their equities. And so we found at Greenwich Academy the most important driver for future returns was making sure we captured the benchmark, which is a great return over time, and could we get some alpha on top of it? And so some hedge fund managers have adopted long only strategies to address that. But there's a potentially even bigger idea of can you tap into the stock picking potential of both the longs and the shorts in what's called an active extension strategy. This is the old 130/30 fund. And so that's really the return streams that fit into the allocators' uh, goals of trying to deliver a return stream that's on the one hand going to provide returns at tough times, and on the other hand generate good returns over time. So that's that side. So then how about, okay, for a bottom up stock picker, well, why don't you just deliver this, just deliver that? And so the answer is that's awfully tough to do on your own if you're going to have a long-term investment time horizon. So if you're going to run a portfolio that's relative value, pair trading, short-term, there are some managers that do a nice job there. Some of the multi-managers have refined that approach to investing. And there's some managers that come out of that and do that nicely. But that's generally a shorter term relative value pair trading. If you're going to pick longs and shorts, this is a great long that's going to go up for 12, 18, 24 months. But I don't know exactly when. And here's a short that's going to be down 50%. That's awfully tough to pair up in this way. And so that's why it's tough to do this on your own. And partnering with CenterBook, which can provide a systematic approach to risk management and portfolio construction, really is a great way for a manager to take what they're good at, which is picking stocks and giving great research, and then delivering return streams in a way that's well structured for allocators' demands.
Yeah, but it seems like if that's where the demand is, what is it about the independence of these managers that they want to run a strategy that the demand is waning for?
Well, the first thing is I think that that's how they want to invest, and I'll just say I can very much sympathize with that. If I think about my whole career as a stock picker, it was not about beta and factor management. It was about finding great ideas, and I'll give a couple of examples. So uh, I was early on in identifying that for oil and gas, the future was going to be in shale, and all through my career, then found companies that were really good at finding those formations and moving down the efficiency curve in how they made money from that. Well, how that stock performed in any given day, week, month, or even year might have less to do with that than what happened to gas prices. And similarly, on the short side, a stock that I pitched at the Irisone conference for when I was at Canadas was Africa Bank, which was a consumer finance company in South Africa. And we recognized that the lending practices were very similar to subprime mortgage lenders, and the financing was very similar to Lehman Brothers, and it was wholesale financed. And if lenders lost confidence, the business could go to zero. And so I came out on stage at Lincoln Center and called my shot and said, "This is going to be a zero." And we got picked up by Reuters and the South African press. But I didn't know when it was going to be a zero, and that stock could be up or down 50% between the price that day and where it ultimately landed. And so there's a lot of alpha there, but how do you then size those positions and how do you manage the overall portfolio construction? That's a whole different story. And this is for CenterBook. One of our concepts is the centaur, and it's named after the chess centaur. And I was unfamiliar with the chess centaur until one of our fund managers shared with me the story that it used to be that a human grandmaster always could beat the computer. And then the computer got good enough that it always beat the grandmaster. And then you got what were called centaur teams, which is pairing human grandmasters with chess computers. And that the chess centaur would beat either the human or the machine on its own. And what is uniquely human for being able to see the future and have a variant perception and be right. And what is unique for the machine, which is to take 30 longs, 50 shorts, and figure out how to optimize the alpha return while meeting risk objectives and minimizing factor exposure. That's a problem not well suited for the human brain. And so what we're all about at CenterBook is bringing those two together to generate returns that either could not generate on their own.
Let's move away from theory a little bit and get into practice. So how many PMs are you working with right now, and how do you go about sourcing these managers and then convincing them to give you this data that for most people they guard with their lives?
We have tens of managers that have joined us to date, and we're growing that count. So we're over 35 now, and we're on our way. We expect 40, 50, and we expect to be over 100 over time. And so the question that you ask is what I had thought was the real question about whether we could build this business was, could we get really great stock pickers to share with us their data? I had seen the data that they, in fact, are great at picking stocks, and that the research provides a great insight into position sizing. But what would the value proposition be for them? And the orientation was very much from my experience running Canadas of what would have been what I would have wanted. How could I have sold it to my LPs? And the idea, if somebody came to me and said, well, this is a hedge fund and they want to trade my data, I would say, you got to be out of your mind. And so how did we make this work? So there are two pieces of it. The first is to protect and do no harm. And the second is what's in it for the business and their investors. So the do no harm piece is what we talked about earlier, which is we need to be very clear about how we're going to trade. We need to provide transparency into the market impact we have, and we need to be accountable for reimbursing. And that's really, we believe we're pioneers in taking that approach, very different than how others have done it. And we think that that's a great foundation. So then what's in it for you? There's really two pieces. One is there are sharing of the money to support the business. And the second is helping you generate better returns in your core fund. And so we start with the first. We provide our contributors with a participation payment that they can think of as being like a management fee. And that's a guaranteed payment for sharing their data with us. In addition, we share the incentives with them. So we're able to do this on a pay for performance basis, where we can track every position of how valuable how it contributes, and can then share the incentives fees earned with with those managers. The other piece that we think is maybe the most underappreciated and most novel is we can provide analytics tools, consultative services to help the managers generate better returns in their own funds. And the idea behind that is that what we do at CenterBook of amplifying the available alpha, uh, mitigating unwanted risks, trading efficiently, those are all great ideas for single managers too. And so we share back with our managers those insights. And it very much builds upon the whole approach and ethos from the software firm Alpha Theory. At Canadas, the reason that we used Alpha Theory was we believed that the tool would help us make more money. And it was providing systematic decision rules, and Alpha Theory provides consultative services to their managers. And what they have shown at Alpha Theory is that a model portfolio constructed by one of their clients generates hundreds of basis points, on average 400 basis points of higher returns than the manager's own portfolios. And over time, by working with those managers, they help the manager's own portfolio get closer and closer to that model portfolio. And they can show how those managers, as a result, generate more returns from position sizing and generate better returns for their fund investors. That's exactly the model for CenterBook. And what we're able to do is to integrate the Alpha Theory optimal position size with risk analytics to provide a risk adjusted model portfolio. And then we can provide consultative services from our partner services team to help them understand why that model portfolio is recommending what it's recommending. Because as a bottom up stock picker, as a fundamental manager, you don't want to just rely on the machine. I would never have done that. The model portfolio I got from Alpha Theory, I always viewed that as suggested model. Well, this is also a suggested model portfolio, but it adds another lens of sophistication, and we provide custom analytics. And it's always good to talk to another human being to help you think through what are the trade-offs. We expect that the users of these tools will generate better fund returns. They'll generate more alpha with a comparable or lower level of risk. And that's ultimately the business that they're in. And it's great for their allocators, great for them. And our aspiration is that allocators will want their managers to become CenterBook Partners partner funds, because that will help them generate the best returns possible for their investors.
So I have to ask, what is the team like? Do you have like account managers who they have funds that are under their umbrella?
Yeah. So the first thing I just say is the mindset of everyone on this team believes that bottom up fundamental stock pickers are hugely alpha generative, and that pairing them with a systematic approach to position sizing, risk management, portfolio construction is really, really value add. And so we're all about it, and it has a certain infectious quality of all of us out there believing in this model and looking to find managers to help. And we began this conversation saying a lot of managers are struggling out there. What I see is some of our partner funds generating extraordinary returns in their own strategy and really struggling to raise money, and in many cases operating on shoestring budgets. And so we're looking to really help them to really be a lifeline in many ways to these managers. And so that's the story that we go out and tell. And some of it is told by CenterBook, some of it is told by Alpha Theory, that there's a real opportunity to unlock that alpha and to share in that upside. So we have an outbound outreach. I'll say for any of your listeners here, we would love to hear from you. We have our website of CenterBook.com, but come find us, and we would love to talk to you. And then we have for our existing funds, we have a dedicated group called Partner Services, and they're all about the mission statement for that group is helping our managers achieve peak performance. And so that's in every part of their fund returns, their business. We aspire to be the best partner, the most meaningful partner they can have.
And have you had any of these partners come back to you and say, hey, one of my big investors is uneasy about this? Do you talk to them? How much IR are you doing?
Yeah, so we do have that from time to time, and so we're constantly trying to engage with the investor community to educate. This is part of the idea behind the white paper that we put out, and then on a one-to-one basis, if there's an allocator that uh, is raising concerns or questions. The first area is to provide support to that manager and information and data. And then in some cases, they've said, you know your story better than I do. Would you speak to them directly? And when we've had that opportunity, it's been a great dialogue, and we've done quite well in helping dispel misconceptions, and in many cases, uh, turning the perception around, changing minds. As I said before, our aspiration is not only for allocators not to object to what we do, but to become fans. And for the allocators who have invested in CenterBook, they are actively a source of referrals of managers to us because they believe that we will help them generate better returns. The other piece of this is in terms of the ecosystem for long short equity. This is increasingly becoming, at the risk of sounding cataclysmic, increasingly this is an existential threat for many of these managers and for this stream of alpha. And so for allocators, this is a problem. If you are an allocator that has moved away from a directional long short equity, you increasingly are stepping away from one of the most potent sources of alpha in the market. And you may be doubling, tripling, quadrupling down in your equity exposure in relative value pair trading that is likely fairly correlated with one another. And so it's important to find where you can access that because that is an uncorrelated source of return. If you think about what you can get from a long-term fundamental alpha, from a fundamental research signal, from an alpha capture strategy built on it, you would think that would be highly uncorrelated with what you have today. If you're an allocator that likes or loves the directional long short, and there still are allocators out there who love this model, uh, you're seeing your current managers increasingly struggle. The other greater concern is what about that next generation of talent and managers? It's increasingly difficult to start your own fund and to scale it. And increasingly, those managers are saying, well, I have no choice but to join a multi-manager. Otherwise, I can't put bread on the table. And so that next generation of managers is at risk of not coming. So we think it's really in the best interests of the allocator community as well to align on and support standards of how alpha capture can be done in a constructive way that can then revitalize bottom up stock pick, because this is a critical source of alpha and is the lifeblood of this return stream.
Have you found that the people who have come to you on the allocator side are more that group that is still interested in this alpha, or they don't allocate to individual long short managers?
So it's very much a split. So we what we find is among some of the largest allocators, pension funds, sovereign wealth funds that have really moved to this strategic asset allocation model, where the hedge funds are a diversifier and the beta comes from their equities portfolio. They are increasingly lamenting that they don't have access to this long term fundamental alpha anymore. They're also concerned that when they're at the size they are, that the smaller managers just aren't big enough for them to comfortably allocate to. They don't want to be above a certain percentage of the firm wide AUM. They may be concerned about the sustainability of the business. And so they are increasingly concerned that they don't have access. In addition, for smaller or mid cap stocks, which are hugely alpha generative, they're struggling to figure out, how do I access that alpha, and they're concerned. So they view alpha capture and a model like CenterBook Partners is a great way to then access that alpha and receive it in a return stream that's a pure alpha, uh, market neutral, factor neutral, or an active extension where the returns closely track the index with alpha on top. And then for those managers that are still in favor of the existing model, they know that the sand is sort of draining out of the hourglass for a lot of these managers.
So what size is the typical manager who's a partner with CenterBook?
Yeah. So it varies considerably. So at the tails, we have managers of over $1 billion, and we have emerging managers at tens of millions. But the typical manager is managing hundreds of millions. And they have typically been in business for at least a decade. So these are managers that are established, that do have institutional capital in most instances, but the size is often lower than managers that this level of returns would have attracted in prior years, and you could see some of the challenges that they're having in their business, and that's part of their openness to considering joining an alpha capture platform. And increasingly, they're open to doing that. And then when they understand our value proposition, are very enthusiastic about embracing.
Now, you had experience with using Alpha Theory, you loved the product. What about managers who there's clearly skill from their returns, but their process is maybe not as clearly aligned with the Alpha Theory process? How do you work with a manager who doesn't use price targets or
Yeah.
something like that?
So I'll say two things. First, taking a step back, for if you're a manager and you do think in terms of price targets and scenarios, there are many of them that have a do-it-yourself version for position size. And while that may be good, the offering from Alpha Theory is almost always quite a bit better. There's a lot of uh, intellectual property that's built up over decades of how you can integrate not just your models and price targets, but also qualitative insights, portfolio decision rules. And ultimately, you need to use an optimizer rather than just a simple Excel spreadsheet. In addition, if you can capture your data and track it over time, there's a lot of insight that you can glean about how capable your team is in forecasting, how capable you are in following the position sizing that can really help generate better returns. So that's for that type of manager, and there are a lot of them. For other managers that say, that's not for me, we have also found a way to collaborate with those managers as well. So we have a partner fund program for managers that use Alpha Theory. We have a contributor firm program for managers that do not. And so what we have found in our evaluation of our data, which goes back over a decade with hundreds of managers, is we have learned how to identify managers that have persistent skill. And we've learned how we can determine how to size positions and trade them in a way that is value add relative to how the managers trade in their own portfolios. So we are very interested in finding highly skilled managers. And what we ask them to do is share with us a few years of historical returns, which we then can run through our analytical process. And if we see something, we follow up with you and make we make you an offer that we find most managers find quite interesting to join us.
Okay. Now, what about your own scale? Is there a limit to the amount of capital you think you could take while maintaining this relatively light footprint on top of your managers? And does the number of managers you're working with determine what that number is?
Yeah. So you're not surprisingly, you're following the business quite well. And so, yes, there are limits to how much we could trade in a given stock based on the liquidity of that stock. And so we have a highly diversified portfolio. The number of stocks that we trade from contributions from our managers, both partner funds and the contributor firms, is over 1,000 stocks, and it's across 25 countries and basically every sector of the economy. And so we're in great shape now with a highly diversified portfolio, but we are looking to grow our manager count so that we can increase that coverage even further. That will allow us to continue to scale the business. And so that's why we've been growing our manager count. And as I said earlier, we're in mid 30s today, on our way to 40 to 50. And we expect over time to have over 100 managers, and that will allow us to scale the business very substantially over time.
Now, what about long only managers? Do they have to be hedge funds or can they be stock pickers from other strategy types?
We have long only managers as well, and they can be enormously productive. What we really are looking for are managers that are really skilled. And so, if I think about that, it's we're able to evaluate returns through a risk model to identify what portion of the returns come from that idiosyncratic or stock specific return. And we have some analytical approaches to identify which managers have that persistent skill. In addition, there are long only managers that are enormously process disciplined. They use price target tools or clients of Alpha Theory, and that can be a very valuable source of information for us. And so we can absolutely partner with long only managers, have long only managers today, and look forward to adding more in the future.
So
Oh,
you've gotten to look at, I'm sure, tons and tons of funds. I'd be interested, how many managers actually do have skill? Like if you were to get 100 potential firms, fund managers to come to you, how many of them are going to make the cut?
I'm not sure we have a sufficiently representative sample to give you something that gives you a good rule of thumb. It is it's not I'd say that it's not everyone, and it's not no one. So it's somewhere between bigger than a bread box, smaller than a house. But what I will say is that this was another quote from our white paper was the death of long short equity is much exaggerated after Mark Twain. Is this idea in the marketplace that there's no skill among bottom up stock pickers is for sure wrong. And I'll just share some data from Goldman Sachs. Is On a trailing 5-year basis through 2024, the traditional long only manager relative to the index actually trailed. So there was nothing there, and so that helps popularize this idea that, well, there's no value in stock. That same data set showed that hedge fund long only outperformed the index by between 200 and 300 basis points, and that an active extension strategy, which is a 130-30 strategy, so longs not 100 but grossed up to 130, and shorts of 30, so you're 100 net long, can generate outperformance in the mid single digits. And so that's very much indicative that there is real skill out there. And we view that one of our key roles in alpha capture is manager selection. And so we have built a rubric that combines quantitative and qualitative variables that we score. And we select managers not just based on do they have skill or not, but how much skill do they have relative to others, and how do they fit into and complement the other managers that we have today. And we are finding there are a good number of managers with a nice flow that are a great fit and encourage us that we will be able to add a lot of managers in the months and years to come.
Now, I guess those studies that people show of people underperforming the benchmark, do you think that is just skewed by the data set that they're looking at public mutual funds, ETFs, and that the best skilled people want a performance fee and they have private funds?
So I think part of it is the long only business as a whole attracts investors that are less well compensated. And as with any market, typically financial rewards and skill align with one another. That's not always perfectly the case. And there are some in the long only world that are enormously skilled. Some of them are our partner funds, and some of them who are out there and are not our partner funds today. We'd love to have you as our partner funds in the future. The other is the scale of this. So part of what I find so interesting in terms of the opportunity for the industry is the sheer scale of traditional long only. So traditional long only today, again, Goldman Sachs data manages $28 trillion, $28 trillion with no excess return. That's as combined to hedge funds with a little under 600 billion in their long only, with 200 to 300 basis points of outperformance. So there's a huge amount of money being allocated to these managers that have not generated outperformance. And then if we think about the active extension area where you can generate even more outperformance, I view that this is the future of how great bottom-up stock pickers, long and short, this is the market and the future for them. Where I view that they're contributing the stock ideas, they're providing that price target information, partnering with a systematic alpha capture firm that can then resize the positions, manage the risk relative to the index, and then trade it efficiently. That is going to be a world class return stream, and there are literally trillions of dollars that are looking for that return stream. The conversations that we have with the largest allocators in the world, sovereign wealth funds, pension funds, they need to put money to work at a scale of hundreds of billions of dollars, and they're looking to put enormous amounts of money to work in these kinds of strategies. And they've expressed to us that their appetite is nearly unlimited for this type of return stream. And so I've shared with the prime brokers that I think that this is the future of their business and their clients' business. So the prime brokers have made a great business helping long short equity hedge funds. It's been a wonderfully profitable business for banks. but it is a struggling business for equity long short, which is diminishing in its funds. And what I've said is this is going to be not only an offset, but should be a huge growth area. And these funds will provide both long and critically short exposures. So they'll provide balances and borrow, all of which are very profitable for the banks. And for the managers, this is access to a market that they're typically not addressing. These directional long-short managers, almost none of them have a long-only strategy. And so they are not accessing this at all, and it's a great way for them to access this. And a final thought on that is that while our core strategy today uh, integrate the data across tens of managers, we believe that the same systematic approach to portfolio construction can be paired with a single manager. And we think that the future will be creating Centaur type funds for individual managers using their own stock picking data and delivering active extension versions of their strategies. And that's a big idea for the future.
My head was naturally going to people licensing like a short book from you, a long only stock picker. Doesn't want to spend time looking for shorts. They're focused on longs. That's what they've always done. Like, is that where things are going?
Well, so for a long short manager, they have the raw materials. They often, the longs and the shorts don't talk to each other as well as you would need to have a tightly risk managed product that tracks the index. And just a moment on that topic. The challenge with 130/30 funds before the financial crisis is if you had the longs and the shorts operating independently, the leverage killed you during a period of market stress. So this was all the rage up to 2007. And then 08, 09, there were a lot of blowups. And that 130/30 for a single manager largely died out. It's coming back, but we think for it to be successful, needs to have a systematic approach to risk management portfolio construction. For those that have longs only, we think that an active extension version of long only is also a great opportunity, so long as you have a lot of alpha with your longs. And so you're going to need to generate a lot of alpha there. But for sure, a systematic firm like CenterBook could provide the short exposure to manage the risk, complement it, potentially add some alpha in addition. That would then create a very attractive single manager active extension for a long only.
If you're telling me that these long only managers or in the hedge fund world have so much alpha and there's all of these assets over here, why aren't the allocators crossing the chasm?
So I think if you give someone a great value proposition, generally they'll jump in. And so if you can provide the allocator significant alpha on top of the benchmark and pay them and have you pay the way that's been done for a long only hedge fund, which is you pay a management fee and then you pay an incentive fee on the returns in excess of the benchmark. If you look at the success of the Tiger Cubs, Lone Pine was one of, if not the originator of a long only version of a hedge fund. And for many of the Tiger Cubs, that's the biggest part of their business now. And it's a great value for the allocator. And it's been a wonderful business support grower for the hedge fund manager for that business. The idea here is to take that even another step further, which is that in an active extension, you have the opportunity to generate even more excess returns by having more leverage where you have skill. But if you're going to use that leverage, you've got to be thoughtful with it and how you manage the risk. And the added benefit here is that one of the challenges that the long only versions have of a number of hedge funds is even at long only, you can have some significant factor exposures that lead your portfolio to uh, move much more than the index and sometimes perform quite poorly. Coming back to 2022, a number of the long only strategies for hedge funds materially underperformed the benchmark index, which raised some concerns among allocators of just a long only strategy. So this comes back to this idea of partnering with a systematic firm that enables that risk management, then gives the fund manager the return stream that will meet the allocator's goals, and then should be able to be compensated well for that alpha.
So all of those tiger cubs, do they have hurdle rates?
So I can't speak for everyone. I could say at Canadas we were a tiger grand cub, and that's how we did. And so
Okay.
our management fee was 1%, and then we would charge 20% uh, over the index, and that's a standard fee for a long only version of a long short equity hedge fund. And the idea for an active extension is that however much excess return you'd expect to generate from long only, you should be able to generate significantly more with active extension, and your tracking error should be less. So I think about this is the have your cake and eat it too. When an allocator looks at the performance of a strategy in the beta one area where they're trying to track a beta of one to the index, the term they use is an information ratio. And so the information ratio is sort of the analog of a Sharpe ratio for a hedge fund. And the information ratio, what it compares is the active return, so the return in excess to the index, to the tracking error, which is the volatility, it's essentially the excess volatility of the strategy relative to the index. So just as you want as high a Sharpe as possible, you want as high an information ratio as possible. And for Sharpe, I think most people think if you have a above a one Sharpe, that's quite good. If it's above 1.5, it's extraordinary. For information ratio, if you're above zero point 0.5, that's good. If you're above 0.75, that's excellent. And if you're above one, that's really rarefied air. And so single managers struggle with that information ratio, with the concentration of their portfolio and the lack of the risk management, even if they're able to generate very significant outperformance. It generally comes with a high track. But by partnering with a systematic firm, you can get even higher active return with a lower tracking error, which drives a major boost in the information ratio. And that is then at a level that justifies hedge fund type fees. And that's what then makes it work not only for the allocator, but makes it very interesting for the manager.
I want to close with a question about sequencing. We've been talking a lot about the future and where you see the industry going. What is the timeline that you envision for these types of concepts and single manager extension funds becoming mainstream? Is this something we're going to be talking about in 2026, or are we still a few years away from the allocator community actually wanting this and the manager community being comfortable offering?
So this is more and more showtime for all of this. So when we started CenterBook and talked about alpha capture, at least in the United States, most people scratch their heads and say, I don't know what you're talking about." In Europe, particularly in London, where Marshall Wace has its home, they understood, but it was this idea of taking multiple contributors' data and making systematic strategies from it. It was a bit perplexing and head scratching. And the idea that an independent hedge fund would make their data available to another hedge fund was viewed as anathema. That's less and less the case. Not only has CenterBook pioneered in this area, but there are other very well-known hedge funds that have entered what's known as buy-side alpha capture and have been discussing it with allocators, generating strong returns. And that is legitimizing return stream both for allocators and for managers to participate. We think we're on the cusp of this strategy really exploding to the upside in terms of the traditional alpha capture, which is diversified across many managers. And we sort of think about this as it's bringing together the best of the fundamental, systematic, and multi-manager, the human, the machine, and the diversification. What is the next leg of that story is this single manager alpha capture and single manager active extension. And so we think that has a good shot at debuting in 2026. When we speak with allocators, there's a very high level of interest. So we think that this is going to go from concept to reality in months and in 2026, and we expect that once this is demonstrated, that there is going to be a very, very big market. There's going to be a lot of interest from allocators. We have a bunch of managers that have lined up saying, we would love to partner with you in this business. We think that this has the potential to grow very significantly.
I know I said I wanted to close with the timeline, but it brings up the question of what is the business model going to look like? Is CenterBook going to be a placement agent? How are fees going to be shared in that single manager model?
So it's a variation on the theme of our current approach. So if you walk in the door of our office, it says CenterBook Partners, and we take the partners very seriously. And so the partnership means that we are sharing the economics with our managers of the strategies that we build together. And that's the idea, is that neither of us could build these returns on our own. Neither of us could attract the capital on our own, but together we could build world-class strategies, and we then share the economics with one another. We have a commercial arrangement for sharing the economics across multiple managers for that model, and we have another model for sharing them with a single manager that we expect will be very appealing to single managers.
All right, David. Well, thank you so much for coming on. Absolutely fascinating. Anybody who's looking to get the white paper, you can go to centerbook.com. There's a form you have to fill out under the Alpha Capture Insights. Anybody as well who wants to look and see whether you might fit as a partner fund, there's a Alpha Capture contributor form that you can fill out. David, is there anywhere else that people should go to find out more information?
Those are the best spots. I'll just give also for our head of our chief partnership officer. His name is Jason Cooper, and you can reach him directly at jcooper@centerbook.com. And we would love to hear from you and love to engage and build a partnership. The vision here is that we can revitalize the long short equity business. In many ways, it's a very personal story. In many ways, these are my people. This is how I began my career. I've loved picking stocks. It's in some ways it's a little bit of a strange conversation, Max, where we've talked so little about individual stocks because that's what my background is all about. And I know your audience talks to you about how does the business work. And so that's the side that I'm on now. And we're really here to be there for our fund managers. And there are some fund managers that had said to us, well, we don't want to join a pod. You're in some ways, you're the anti-platform. You're how we can stay independent. And we have stories of managers that we've allowed them to stay independent and run their own business. And we think we're on the threshold of helping launch new strategies, help them grow. And we're excited about it. Really appreciate the opportunity to talk to you and to engage with your audience, and appreciate their reaching out to us.
Thank you, David. The pleasure is all mine. I hope you enjoyed today's episode. Looking to learn more about Fiscal.ai? Check out the link in the description to get 15% off any paid plan, including Fiscal's Enterprise tier, which is designed specifically for professional investors who need access to downloadable data. Until next time.